Hey guys, today we're talking about how you should invest during market volatility. Specifically, the 3 steps that will help you stay out of the headlines and know your money is working for you no matter what the market is doing. There's a lot of emotions in investing, and it can surprise some people just how much that impacts you when the market gets rocky. I love talking to friends who laugh off the question about how would you feel when the market drops 10%? Because they don't think they'll actually react when the market gets volatile like this. But I know that same skeptic who doesn't think they'll need that guidance might end up reaching out later on. This is Tony from Wealthfront, and today we're going to talk about what you should do during market volatility. All right, so the first step is to remember that the market will go up and the market will go down. You have no control over this. You definitely won't know when it's going to happen, and you shouldn't try to play the guessing game many of us think we can do. In the long run, the stock market is pretty consistent when looked at from a long-term bird's eye view. Over the long run, despite short-term ups and downs, the markets go up. They just do. The key to investing is to have the right discipline to stay the course and stick to your long-term plan. And so with that, you have to accept that volatility is completely unavoidable. That's right. In a perfect world, the market just goes up and up and up and boom, it goes to the moon, right? But come on, we're living in the real world, and volatility is going to happen every so often. Now, when I say volatility, I simply mean sharp movements day to day, up and down, typically more than 1% or so in a given day. Now, it's all relative too, because if the market is not volatile for a while, and then all of a sudden it drops, let's say a 0.5% or 0.5% in one day, you're probably going to think, oh wow, that's a big drop. But if the market is consistently volatile, which we have seen in parts of 2021, you may see a 1% drop and not worry at all. Emotions are not rational sometimes, and this is a good example. Just remember this. In data, we trust. All right, let's all say this together. In data, we trust. Here, from 1998 to 2018, the S&P 500 dropped more than 5% in 25 months. But despite those bad months, the index was pretty consistently positive with an annualized return of just over 6% per year. It would be really easy to let fear take over during one of those bad months, right? I mean, there's a lot more data out there supporting that you just shouldn't let emotions take over. We get it. We've talked about it enough. Second key point here, set it and forget it. Easier said than done, right? Sure, go ahead and tell me again why I shouldn't look at my returns and feel the need to jump in. Okay, I'm not going to lecture anyone out there, and I've talked about this enough. So just remember that I'm simply giving you the framework I want you to consider for your investments. This means that you want to try to stay away from jumping in and out and making adjustments to your investments during volatility, whether the markets are up or whether they're down. You might make an adjustment and come out ahead, but the majority of us will negatively impact our returns in these cases just by jumping in and doing things like that. The most common way investors do this is selling when the market goes down. I mean, it's kind of human nature to feel the need to protect your principal and stop any potential loss, so this kind of makes sense. And Dalbar, D-A-L-B-A-R, a really good market research firm we've all heard of, right, has done a ton of research on this and found that investors who sell when the market drops, for example, lose about 4% per year by simply just not staying the course. 4% every single year adds up. Now, it might seem very odd to see the market going down and just sit tight, right? If you haven't been through this, you'll understand eventually. All investors go through this, and only those who stay put come out ahead. To illustrate that point, imagine this. It's late 2007 and the stock market is in fast decline. January 1st, 2008, you decide to sell your position in the S&P 500 for $100,000 and deposit it into a savings account that earns 2% interest. As of June 30th, 2018, that account would be worth about $123,000. Not bad, right? But what if you hadn't touched your investment at all? 10 and a half years later, you would have seen a 130% return, meaning your money would have been worth $230,000, a difference of $107,000. It's pretty clear which move paid off during one of the worst times in the modern stock market history. The same example can be used for the 2020 market crash or really any other big market drops. Now, a question I often receive is, well, why don't I just sell off as the market's going down, protect my investments, with little downside there. And then when the market reaches the bottom, I'll just redeposit my funds and then I'll take part in the upside, right? Win-win. Sure, if you know exactly when the bottom is, then of course this scenario is ideal. But no one actually knows where and when that bottom is during a big market drop. So it's not that you don't know when to sell off. It's that you don't know when to get back in. And if the market tends to recover super fast, like it does in recent history, for instance, you'll likely end up getting back in too late and missing out on that quick recovery. Okay, and lastly, the key to investing during market volatility and especially big market drops is to use automation strategies that allow you to optimize your investments during all market conditions. Passive investing is the first, which is the type of investing strategy in which you minimize the buying and selling to stay put for the long term. It can be a great way to weather all market storms. Now, passive investing can be summed up as investing in a diversified portfolio of low-cost index funds. This strategy builds on the assumption that the markets go up long term. And that is a safe assumption since global economies have consistently done that over the last several decades. But there's no guarantee that that'll happen. I'll certainly bet on that one though. Since periodic turmoil in the financial markets is bound to happen, diversification is the key to long-term investing. In any given year, one asset class may rise and another may fall. No one knows or can predict which asset classes are going to outperform any given year. In the last couple of years, the best performer has been the US asset class, but who knows what that will be over the next decade? By investing across all asset classes, so we're talking US, emerging markets, foreign markets, you might be able to insulate yourself from losses while tracking the overall performance of the broad market. By choosing passive investing, you're following the movement of the financial markets rather than just a few stocks or even a few asset classes. And as long as the financial markets grow over time, your wealth will accumulate. Another great strategy to use is dollar cost averaging. This is an investment strategy where you spread out your deposits to an investment account as opposed to depositing it all at once. You basically invest equal amounts spaced out over regular intervals, regardless of price. You take out the guessing game of the market timing and you simply let your money invest at that day's prices, regardless of the market conditions. So what happens is when the market's up, you end up buying less, and when the market is down, you end up buying more. It just happens automatically with dollar cost averaging. This can put you in a potentially better position during volatile markets, assuming the markets steadily rise. To implement dollar cost averaging, you would set up a repeating deposit to your investment account, and then don't mess with that set interval. Many investors do this by setting up bi-weekly deposits that occur on their paychecks, but you can also do this, for instance, on a weekly basis, if you like seeing more consistent deposits. Personally, I'm a believer that if you have the funds ready to invest, get them in the market and get them working for you ASAP. I don't love the idea of taking, let's say, $10,000 in cash and spreading it out over 10 weeks, let's say, with a $1,000 deposit each week. I'd rather get time on my side in this sense and get all that invested right away. Remember that the key to investing is time in the market, not market timing. But with that said, I certainly understand why many investors like dollar cost averaging, especially during volatile markets. The next strategy to optimize your investments during market volatility is rebalancing, preferably automated rebalancing. For many passive investment strategies, you start with a target allocation percentage for each asset class. As time goes on, some asset classes rise, some fall, and therefore your portfolio drifts away from its target allocations. Rebalancing is simply the method of readjusting your portfolio back to its target allocations. This requires you to sell holdings in asset classes that have drifted above their target percentage and buy more of those that have drifted below their target percentages. This is tough to do sometimes because you have to sell your winners and buy more of your losers. Sounds kind of odd, right? This kind of goes against human nature. So I let software do it for me. And I don't have a chance to step in and make any manual adjustments because I might not like to do that. If you believe in the power of passive investing and automation using the history of the market data, rebalancing back to your target allocations during all market conditions puts you in a better position long term. From 2000 to 2010, the US stock market overall stayed pretty flat, meaning that if you just invested in the US asset class during that time, you were left with basically exactly what you started with 10 years earlier. But while the US market didn't see any returns during these 10 years, other asset classes performed much better. If those investors had diversified across asset classes and regularly rebalanced, they would have been much better off than just investing in the US asset class. All right, and lastly, the most important automation strategy of them all, saving the best for last, is tax loss harvesting. This one is super important during volatile markets because it's a strategy that takes advantage of investments that have declined in value, which is a common occurrence in broadly diversified investment portfolios at any given time. So by selling such investments and replacing them with highly correlated investments, you can capture tax losses without changing the return characteristics of your portfolio. These recognized losses from tax loss harvesting can then be used to reduce your taxes for the year. Without tax loss harvesting, you simply let the investments go up and down without capturing any losses. With tax loss harvesting, you would potentially sell investments that go down below what you paid for them, capture the losses that you can use to offset taxes, then reinvest the proceeds into correlated investments. I know it sounds weird to think of using losses to your advantage, but in the case of tax loss harvesting, they are good for you. All right, so to sum up, investing in the stock market means experiencing volatility. You can't control it. You cannot predict it, so just deal with it. Don't let fear of down markets push you to adjust your investments or make any bad decisions. Trust passive investing, keep your eyes on the long term, and use automation strategies like automated rebalancing and tax loss harvesting to your advantage. At Wealthfront, we do all of that for you using software to your advantage. Thanks for tuning in. This is Tony from Wealthfront. Take care.